Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, global markets reporter at Nasdaq. National Financial Literacy Month is celebrated in April, which is a great opportunity for us to check and promote our financial situation and skills. Joining me is Seth, Wunder, Chief Investment Officer at Acorns. And for this segment, we're going to discuss the stock market. Seth, it's great to see you. Welcome back to Trade Talks.
Thanks for having me.
How do you know a company will grow for the next 25 plus years?
You probably don't, but the reality is lots of great companies do have sustainability. The way to think about it is think about the things you use every day in your life, where you've gotten either services or products that you have a high affinity for, that you know are high quality, that you see yourself using more over time. If you go back 25 years, did anyone really foresee Amazon going from just selling books online to selling the massive things that they sell today? Probably not. But if we look about how we use Amazon in our lives and saying, okay, we first bought a few things, now we buy a lot of things, and now we buy them more frequently, you start to get into a understanding that companies similar to that have the best opportunity to do well over the really long term. So, Warren Buffett's, kind of known for saying invest in the things you understand. And I think the 25-year time marker might feel like a long time to make that sort of projection. But I think if you sort of look around and take stock on, no pun intended, on what you're using every day, I think that's a good cue for figuring out which companies have staying power.
What does it mean when interest rates are high versus low?
Yeah, so interest rates, the really simple term is it's the cost of money, right? So when interest rates are low, and let's say low is 2%, if you need to borrow money to buy a house or you want to borrow money to start a business, the cost of that money at 2% is low, certainly versus history. So on $100, you'd be paying the bank an extra $2. When interest rates are high, 8%, 10%, if you go back 40 years ago, they were even in 15% range. What that means is that now the cost of money is expensive. So for the same $100 you borrowed, you might have to pay the bank 10% or 12% or 15%. It's not necessarily, whether the cost is low or the cost is high. There are periods for both. And what the Fed does and the government does is they regulate whether the cost of money and interest rates are low or high based off of how they perceive the economy doing and what they want people to be able to afford. And we've had tens and tens of interest rate cycles, if you will, or movements from low cost to high cost, over the last 100 years, and we'll continue to have them in the future. And so what you want to do is you really want to try to borrow money when the cost is low, and you want to be cognizant of how much you borrow when the cost is high.
And Seth, what does micro-investing mean and what's the benefit?
Yeah, so micro-investing refers to the idea that you're putting small amounts of money into your investments over a longer period of time. And so for example, if you wanted to invest $100 into the stock market, into a broad-based ETF, that's great. But if you wanted to do that as $20 every month over 5 months, that would be more referred to as micro-investing, of having that more systematic, smaller investment process. The benefit is this concept called dollar cost averaging, which is, when the stock market or a particular stock goes up a lot, if you invest the same amount of money, you would end up buying fewer shares when the stock price was higher. And then when the stock price goes down, because there always are highs and lows, you would end up buying more shares of that company or the stock market when the price goes down. And so the consistency over time helps you buy more stock or more shares when it's lower. And it really spreads out your investment. So, people worry about volatility or how much prices go up or down and how quickly they go up and down. The idea of micro investing is to really take advantage of that volatility and use it to your favor. So once you start and you get into it, you start the process of micro investing, you really will understand. But it is the right way to think about first of all, how to get started, but certainly how to stay systematic or consistent in what you're doing.
And finally, what is inflation and how does it affect the stock market?
Yeah, so we all know inflation because we've had, a grandparent or two along the way who reminds us about what things used to cost when they were little. Inflation is just the idea, really simply, that prices of goods or services, a movie theater, a baseball game, or whatever, go up over time. What people get worried about when you hear the term inflation relative to the stock market is that the cost of goods or services, or the prices, go up too fast. And so, we don't have time for our money to grow in the stock market, or for, and so what we can buy with our money becomes a little bit less because maybe food costs go up or so forth. Broadly speaking, low levels of inflation are actually quite healthy for any economy. And then when inflation moves a little too fast, that's when the Fed, as we were just talking about, the cost of money might make the cost of money a little bit higher to slow down some demand, to allow inflation to settle out. Inflation impacts the stock market because people get nervous. They get nervous that if the cost of goods goes up too fast, that they won't be able to buy the same amount of stuff they could buy before. Sort of $100 doesn't go as far for you. But the reality is inflation cycles are normal. Interest rate cycles are normal. There will be some volatility around that, but it's something that we've seen consistently for 100+ years of investing, and the market seems to work its way out over time.
All right, Seth, thank you for joining us for National Financial Literacy Month. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.